As a quick reminder, hey guys, Michael Mnatsakanian. I'm a real estate investor. I've been investing in real estate since 2020, learning about it since 2018. In the last couple of years, I've been able to grow my portfolio to over $22 million of real estate, primarily leveraging three key principles: creative financing and mastering deal analysis for creative deals. Creative financing, capital raising, and then co-living, my favorite management strategy. So I do a lot of all three of those things. And what I'm going to share with you today is we're actually raising capital for a deal. We're going to be doing the presentation tomorrow, but I am going to drop the comment right here in the comments. So this is if you want to be part of a webinar tomorrow that we're doing in regards to a capital raise. This is for 4 properties in Texas. One of them is an operational co-living property. The other 2 are short-term rentals being converted to a co-living property. And the third one was just recently acquired, leveraging creative financing. And that will also be co-living. So this will be 30 total co-living rentals. I can quickly share screen. So you'll be able to register. You'll be able to register for the event by going to this link. I don't need to share it anymore. You'll be able to register for it and be part of the live presentation. If you are part of the previous capital raise, I think you recall, we raised over $800,000 in, I don't know, in a tiny amount of time, in less than 72 hours. So it's just, this was a Georgia co-living. It just boom, boom, boom. People were investing. If this is something that you want to be part of, I highly recommend that you do it. Make sure to go to my Instagram. It's going to be the easiest way. You can go to my Instagram, and in my stories, there's a link for the event. So go to that. You can register. Whether you are someone who wants to be a owner of this deal with us, for as little as $5,000, you can be an owner of $1.4 million of co-living rentals, 30 total rooms in Texas, and then learn throughout that process. Or if you just want to attend and learn how you can do what I do, how you can raise money for these deals and see how it's presented, or deal analysis, you're more than welcome to attend either way, whether you want to actually be an investor and partner, or you want to just learn so you can do it for yourself. So make sure to register for the event tomorrow. I dropped the comment in the links. Let me drop it on YouTube as well, or on Instagram. All right. I don't know how to do that, which is fine. All right, whatever. So we'll drop it on Instagram, but it's already on my story. So if you're on Instagram, just check out my story. It's going to be the easiest way. Just dropped it in there. All right. So just quickly, right? This is 4 properties, as I mentioned. We'll be going over the entire presentation tomorrow, the deal analysis, the team, why pad split, why these properties, all this good stuff, so all the properties are there, the analysis, and we'll go deep into that. The 82% return on investment over the next 5 years, which is awesome. That's an incredible return for total return on investment. We will start this capital raise officially tomorrow. And then, here's the analysis we'll be going over. Basically, we did individual analysis per property, and then it's going over the total portfolio and kind of what that looks like for our capital partners. And if you want to learn how you can do the exact same thing, that's why I have the Super Investors community, right? It is a community for real estate investors that want to buy and hold real estate, ideally as efficiently as possible, to financial freedom. And once again, that's my 3 pillars: creative deals, buying creative deals so you can maximize your cash flow and get much better terms than you ever would creatively, or than you ever would traditionally, right? The raising capital for these deals, as well as the co-living management strategy, just so you can get much more cash flow on these investments. So I'm sharing this with you today because today what we're going to do is we're going to live analyze a deal. This is a super investor deal. They brought it. I'm not going to go over the address and all that. We're going to pull the information, verify the rental income estimates. It's a straight seller finance deal. This was on market, but this was from a flipper who owns it outright and is open to seller financing it at the right terms. So we're going to help structure those terms. And with that being said, what I need to do is we're going to go to the super investor school community. If you don't know if you're interested in signing up or want to have a call about it, just reach out to me over Instagram and I can, we can get on a call and see if you're the right fit and if it's the right fit for you. I just dropped the link in the chat for anyone that's interested. I always have to remember to do that on Instagram as well because it doesn't all work the same. So I just did that. Boom. All right. So what we're going to do now is we're going to analyze deals. If you know anything about me, you know that deal analysis is my thing. And I've created this incredible calculator for deal analysis. So we're going to start with this calculator. The reason why this is so powerful is not only can you handle cash, traditional, sub-2, seller finance, or hybrid deals, you also have the automated analysis for capital raising. Like literally, this will tell you what does your private money partner get for what their contribution is for the entry cost, whether it's long-term, midterm, short-term, or co-living, right? My favorite, co-living. Depending on the percentage you offer, what do their returns look like? Year 1, 5, 10, 20. If you have a private money lender, what do the returns look like for you? Does this deal work with a private money lender? When you're raising money through private money lenders, you have this, you just plug and play this information. Private money partners, you literally share this as a resource for them so they understand what their returns will look like over your hold period. And all of this is automated, including the long-term analysis. All of this is automated once you complete your deal analysis page. There's going to be some updates coming to this soon, but the gist of the calculator is going to be the same. So that being said, I have the property. What we're going to do right now is I'm going to plug and play the information. This is a Atlanta, Georgia property. So because it's not under contract yet, I'm not going to go too far into the weeds of it, but I'm going to show you how you're going to use this and how we can renegotiate the deal, restructure it so that it does still make sense for, if it does make sense for creative based on the numbers that were provided in some of our own analysis. So there's the Atlanta, Georgia. This is actually an 8-bed, 4-bath duplex, which is pretty awesome, 2,500 square feet. We're going to be going the pad split route, so it's duplex. Each unit is 4x2, which is great. You would not even add any square footage to this, and in theory, this would be a property that's already turnkey, ready to go for acquisition. The seller is mentioning that this rents for $2,500 a piece, each one. It depends on the area. You could maybe get that in Atlanta. I mean, a 4x2 could get that, but it just depends on the area because there's plenty of areas that you would not get that. But it's not crazy absurd. So if you wanted to, you could go 4x2 and 4x2. That's why it's multiple areas. So it's, 2 units. These are $2,500 a pop. If I was going to share the address, we could do Rentometer and we could look at it. We could go on Zillow, all that. What we're going to do right now is how are we going to gather the information from pad split, plug it into this based on some of the information I am sharing with you, and where are our pillars to renegotiate this deal to see if this is a viable strategy as is or what terms we need to get to. So I'll tell you that the purchase price is $390,000. Great question. So Michael Kong asked, where can we find that calculator? So you can purchase the calculator on my website, michaelmnat.com. Or if you're a super investor, you get access to this calculator, lifetime access. This is the super investor link. And if you want a free version of the calculator, just go to, if you want a free version, it's not nearly as detailed, but it still provides the ability to analyze creatively, traditionally. Well, really it's a creative calculator. So sub-2, seller finance hybrid. It's in my buy box page, which I just dropped in the link. You can go there and download a free copy of the calculator and have my free school, right? So if the wealth to real estate investing community, I'll just quickly show you that. So the wealth to real estate community, if you go into there, the classroom, you can get the free calculator. I just dropped the link for it, but you can get the calculator by going into creative real estate investing. Oh no. Go to the community and you go to, oh, I lied. It should be in here somewhere. All right, we'll have to figure that out. I don't know where it is in here. But if you do the link that I just shared, if you go to this buy box one, So if you go to the one I just shared, you just go down to get my free creative finance calculator. You put your email in there, it'll automatically come to you. I'll need to put that back on the page. I think I removed it because we switched it from a Squarespace website just directly to send you over email. So it's way easier and automatic instead of someone having to click it. So you go in there, you want the free calculator that's in here. If you want the paid calculator, it's on my website, michaelmnat.com, or better yet, just join Super Investors and you won't just learn how to analyze deals or have a calculator. You'll really learn how to analyze deals, renegotiate them, raise money for them, maximize your income through advanced creative finance strategies and co-living. That's kind of what all that's for. But on my website, you can find some stuff. Cool. Let's go back to the calculator. So let's analyze the deal. All right. So we're going to assume 10% down payment. That's actually what I was told, that the sellers open a 10% down. We'll see if that's viable. I assume that would be viable. There is 0 sub-2 loan being taken over. So that means the entire remainder of $351,000. Oh, actually it's $390, $39,000 down, 10% down, $351,000 of seller finance. Let me zoom in a little bit for you guys as well. Of seller financing, we will adjust these. So there's no terms right now, what interest rate, monthly payments and all that. We'll do that after we get our information set up. So for the taxes and insurance on this property, what I have is $2,405 annually, and then $1,300 for insurance. I think this insurance might be a little low. I'd reevaluate that because I can't share the address with you guys right now because it's a live deal. I can't verify that, but you can use V-Home Insurance to get a rough idea. You go to by location. We're going to go to Georgia. And it's going to say properties that are between 3 to 399 is $1,299. All right. So this says yes, but if it's co-living, it's going to be a little bit more expensive. Like it's roughly within the ballpark. So that's great, but it's going to be a little bit more expensive. For the time being, we could just add a buffer under the other, just insurance buffer, and add an extra like $25 as an insurance buffer if it goes up. If it goes up, then what this is. And then we have the taxes. So $200. I can't verify that right now without the address, but that is something you should definitely verify to make sure. I can look on Zillow real fast and see what they previously paid. But the fact is the property was recently renovated massively. So the insurance that they were previously paying should be much lower. Yeah, this insurance is way off because the taxes they were previously paying is around $3,000. I assume it'll be more than that this next go around. For the time being, we can put $3,500, but you need to verify this amount. So $300 a month. And so we have insurance. We have estimates for insurance and taxes. You'll need to verify these numbers. We have an estimate for the seller finance, just assuming 6%, 30-year term, fairly standard. The first payment would be, well, it's April 1st now. So let's say we close by the end of this month. So that'll be the first payment. All right, we'll go back to this once we get our analysis. Once we get the income, then we'll come back to this and see what the deal looks like. We're going straight to the pads. Actually, we're going to do our entry cost, then we're going to go straight to the pad split. So we have, there's an agent commission on this one of 2.5%. We're going to put just a couple grand for cleaning this property. It's already turnkey, but just a quick clean. Closing costs, we're going to approximate the 2%. We're more likely going to be the ones to buy it pay for it. You can maybe structure that so that the seller has to pay for some of it as well. We'll see, but I assume that will make a huge difference on the analysis, much more than actually changing the cash flow. That's my favorite thing to do. You're going to have to pay a transaction coordinator. You're going to set up your LLC. You're going to have an inspection. It's going to cost you a few grand. There's a wholesaler on this deal, and they're getting $10,000. And then for these properties, there's going to be a lot of what I see, the analysis that was done by the super investor was they're raising a lot more for renovations or for the carrying costs. So like your reserves up front, which is great. It means they probably are pulling less monthly and they're raising more up front, which is great because they're probably going to get years worth of reserves already up front instead of having to pull it out of the cash flow every single month. So if we scroll down, so this is broken because our date is broken. So let's just put 5-1. All right, well, we're not going to worry about the long term quite yet. Okay, so it's because of this. So we're adding no new bedrooms because it's already 8 bedrooms. The way this property works is there is no private bathrooms. Everything is a shared bathroom. And now what we need to do is estimate this is actually going to be 1,500 times the 8 bedrooms that we have up above. This is going to add this extra furnishing cost into here. This 91,000 is with these entry costs plus this 91,000 added here. What we're going to do now is based on the zip code, we're going to see what this property rents for. So if you're not on PadSplit yet, please use my link to get free access to PadSplit. It is literally such a cheat code. It is like, it makes your life so much easier to be able to analyze co-living deals. I actually have no idea how you plan on analyzing deals efficiently without using the PadSplit platform. So once you're on there, absolutely free. You don't pay PadSplit unless you're using their platform to manage your assets, which I do. I highly recommend it. They crush it at that. They don't manage it. They help you. They are the equivalent of Airbnb for short-term rentals. That is what PadSplit is for co-living. So they help you find your tenants, collect income and all that stuff. I don't know how it's so much more work to do it without. It's not that I don't know how you do it without, because we have properties that are not on PadSplit, but it is so much easier when you have their analysis to leverage, and it's literally for free. It's one of the host tools. It's Market Insights, and it's the thing I go to every single time to be able to understand a market. So the zip code that we are looking at is 30314. Oops. 30314. Okay, 30314 has 378 active units. Properties with share bathrooms are renting for 184. Private bathrooms are 281. Average occupancy is 90%. It's great. 7 days to first booking, 45 days to 80%. That's solid. Let's see if we can actually see where that is, though. Let me also pull it up on the map. Pull it up on this map to get a rough idea of where we're looking. Oh, okay, cool. Cool. Yep, right here. So this area, perfect. Great. There's plenty around it as well. So it's not like we're talking about some fringe area of Atlanta. Like we're not talking about several markets over. And just to quickly show you how you determine if a market is still a good market. So there's 6,897 units right now in Atlanta, Georgia. These are co-living rooms, 182 more coming. Awesome. The demand in the last 30 days, 31,550 people searched for properties in Atlanta in the last 30 days. So even though this seems like there's a decent amount of active units, there's way more people searching actively in the last 30 days than there are available or upcoming units combined. And this shows you the overall weekly shared bathroom and private bathroom for all of Atlanta, the average rates, right? It's a big market. It includes all of this, but and the average occupancy of 89%, 9 days to first booking, 33 days to 80% occupancy. It shows you all this stuff. If you are not using the PadSplit platform to at minimum get data for co-living, I don't even understand why. You're just making your life harder. Please don't do that to yourself. It's not in your advantage. If you know anything about me, I really try to highlight that the goal is to become financially free as efficiently as possible. I do not want to work harder or longer than I need to achieve my desired result. Some people work extremely hard and extremely longer for a lot less result. That doesn't actually make sense. Why would you not want to work more efficiently, work smarter, and work more efficiently to then get the same result or a higher result, then work harder and longer for that result? There's a lot of words, but what I'm trying to say is don't make your life harder than you need to. Real estate investing is already hard. You are one of the few people in probably your entire circle that is even spending time like this, watching these videos, learning this kind of stuff, spending hours of your day, money, traveling, learning all these things to try to make a difference for your family and your financial freedom and your future. So don't make the process harder than it needs to be. Invest correctly, invest in the correct deals, invest in your education, invest in things that will help you achieve your desired result more efficiently. Don't be proud of working harder or longer than you need to, like I used to do. I say this as someone who spent 18 months before I bought my first deal, just analyzing deals with nothing to show for it but numbers on a spreadsheet. So what I mean by that is work intelligently, work intentionally, work strategically, leverage the tools and resources that are out there. And if you are able to, leverage some of your savings to be able to invest in yourself to expedite your journey to financial freedom. That's the ultimate goal. I don't think anyone wants to work harder or longer than they need to. And if you do, that's awesome. Like, I mean, that's great. It's great for you. Okay. So 30314, let's see what his analysis stated for the income, 185, 284. It's a tiny bit off, but not by much. So even though we have no private bathrooms, we're still going to hit that there. All 8 of these units they share the bathroom. So it's 4 bedroom to 2 baths. So 2-to-1 ratio, which is awesome. 2 bedrooms to 1 bath. The most you can do is 4-to-1 on pad split. You don't want to ever really, ideally don't want to push to that. You can, and it's possible. Just the less people sharing a bathroom, the more likely your property is to have tenants that stay longer term. I mean, that's the reality of it. So your income then is 64 at 13. Oh, whoops, was I off by $1? Yes, I was off by $1. 184 and 281. I was off. I don't know what I was doing. Off by a few bucks. All right. Then we have your PITI and HOA. There's no HOA fee, but that is grabbing the data from here. It's saying your seller finance payment, your property taxes, and your insurance. All that. Oh, plus this 25. Let's just add the 25 in here. So it's another 300. So then that pulls as well. So this is part of the reason why I'm reformatting this calculator. So it's a little bit it's a great calculator, but so things line up a little bit more easily with each other. All right. So then you have that information pulled here. We're estimating $600 a month for water, electric, gas, trash, and internet and landscaping. That's fairly accurate for where we're at for our properties in Atlanta. Obviously, you should be getting quotes for this kind of stuff, but your electric's going to cost you a few $100. Your water's going to cost you a few $100. Like your electric is electric and gas. Internet's going to cost you around $100. And then your landscaping, trash, all that gives you a little bit of a buffer as well. If your tenants start getting extremely wasteful with utilities, then talk to them about that. For this property, we have the pad split property management fee at 12%. In reality, pad split charges 8%, but they also collect the first 10 days of rental income for someone new that moves in. So they collect 8% of the income, but they collect the first 10 days of a new move-in. The longer your tenant stays, the better this is. The better of a deal this is for you. The less they stay, the worse of a deal this is for you. If there's more turnover, you're giving more to pad split than if your if your tenants are staying longer term. So that's all in here. It's all linked in the calculators. That's all in here. Even the free calculator, I'm revamping that to include CoLiving in there for you guys as well. So don't worry about it. It's not going to be as robust as this, but at least you'll have that option. So that's why it's 12%. So on average with the rough turnover, it's around 12% for the year. Obviously, you're going to pay a lot more of that up front when you're just listing a property and you're just getting it rented out. But after it's stabilized, it'll be roughly around 12%. So the other property management fee, this is the cost that we've seen, whether it's in-house or others. Some people will charge 10 or 15%. If they're doing that, they probably are not also leveraging the pad split platform. In this instance, I know that the super investor will be self-managing a portion of it, and they're going to use this to cover the cost of a VA. $300 is more than enough to have a VA for this property plus a couple others. That starts becoming very scalable when you have multiple properties that are being managed, because you're not going to need this full amount for one VA. You're going to have multiple properties. You don't need to redo it every single time and have this amount. Like my one VA manages multiple co-living properties for us with the support of where I'm at now with an asset manager and VAs. But you could do it just yourself in a VA while you're starting out and then outsource that to free up your time to then scale your portfolio. But he's willing to do it. He said he'd do it for free. I don't agree with that. I'm putting 5% because you want to make sure you have enough money coming in so that your property is so that your property is generating enough income to then be able to outsource that, because you don't want to buy yourself a $300 a month job. I mean, he might, and a lot of you guys might say yes, but if you want to scale, you can't just spend all your time and energy on managing your properties. Fortunately, as you get more cash flow, it's not going to make a huge difference. As you get more cash flow, you can leverage that to outsource it, but it's better to underwrite your deals with some level of money set aside for that. All right, vacancy. So we saw for this market, 90% average occupancy. So that means if it's 90% average occupancy and there's 100%, they could be rented out. That means there's a 10% vacancy, right? So if it's 92% average occupancy, that's an 8% vacancy. So 100 minus 92, 8. Or in this instance, 100 minus 90 is 10. So we're going to put 10% vacancy. If you've heard anything that I've been talking about recently, for maintenance and CapEx, you do not need to save $638 a month, 10% of your total income. Like the 10% towards maintenance and CapEx is kind of the rule of thumb for long-term rentals. However, in reality, you're not going to need to save this incredibly large amount every single month, like $7,654 that you would if it was long-term rental. So even if this thing was generating $4,000 a month as a long-term rental, 10% of that is $400. This property, you're setting aside $638 a month, when in reality, like CapEx, the capital expenditure is going towards your roof and your appliances and those kind of major capital expenditures. Those things are not necessarily going to change drastically in like their lifespan, just because it's rent by the room versus long-term. The maintenance might go up, but that's not going to be this massive amount like in addition to that. Maybe it's a few $100 here and there in addition. So instead of going the full 10%, I would do no less than what you would get as a long-term rental, which in this instance, like I said, let's say around $400. So if you go around, let's go 8%, right? So you have $510 a month you're setting aside for maintenance and capital expenditures, $6,000 a year for maintenance and capital expenditures. That pushes you below the pad split cash or the cash on cash return. I advise $100 or $1,000 a month in cash flow for co-living, right? That's not the same for long-term, but for co-living, and then a 15% cash on cash return. A lot of people are willing to go 12%, 10%. It depends on how are you funding the deal. Is it your own money? Is it someone else's money? Is it a combination? That's going to depend on the returns that you're looking for. I personally don't want to do any real estate investments that have less than a 10% cash on cash return. And because I raise all the money on my deals, my partners are getting a portion of that. And then I'm actually getting infinite returns in that scenario. Like my returns, it's not my money. It's me putting in the work to find the deal, own and operate it, all that good stuff. But it's not my money in the deal. So my returns are my return on time, which is not the same as putting in actual money into the deal. So that is, for me, I like around 15%. So when I split it with a partner, it's got great returns for them. And then $1,000 a month minimum cash flow. So at least we're making several $100s each. And there's a little bit of wiggle room if the numbers are a little off as well, because that can happen. All right, so a few things you can do here is you can further reduce your maintenance and CapEx. That's one thing you can do, and just pre-raise more of it up front. Doesn't mean that's always the best play, but you can raise maybe 2 years worth of this and reduce this by a couple percentage. There's not like a perfect science to it. You can take this down to, let's say we're going to add $12 more $1,000 here, and you're going to have, I kind of like the idea of raising more money of reserves up front rather than pulling it each month. Because if something goes wrong, then you have the money there ready to go instead of like waiting for it to accumulate. And let's say you don't have enough yet. And it's like, what are you going to do? So here, maybe we could take this and add $12,000 in here. Obviously, it's going to take your cash on cash return from the, let's see, from the 13% it was. Let's put 13% here. From the 13% it was. And we can put 1017 for cash flow. That's really what this is for you to see what the different scenarios are. But right now, we're just going to put it here. So $1,000 a month of cash flow, 13% cash on cash return. Well, if we add $12,000 of additional reserves here, 2 years worth of reserves already up front, we're raising for that. That brings you down to 11.8%. Doesn't affect your cash flow, right? Because you're not affecting your cash flow, but you're affecting your cash on cash return is your annual cash flow divided by all the costs, the entry cost to get into the deal. Well, we didn't change the cash flow. What we did was increase the entry cost. However, now we're going to adjust for that by reducing this monthly. We're probably going to cut that down to around 5% or even half because you're raising 2 years worth up front already. So you're going to still set aside $3,000 a month or $3,000 a year or $255 a month, but you are pre-raising $12,000 of cash flow. And what you see here, what happened, your cash flow went up, right? Because you're setting aside less each month. Your cash flow went up to $1,272. And the change that it had on raising 2 years worth up front allowed you to, even though that went up, your denominator entry cost went up, the increase in cash flow was more beneficial than the impact on increasing entry costs. And that's pretty close to the 15% that you're looking for. What is more important then, because this is seller finance, let's talk about how we can restructure the debt. This is going to be very simple because it's seller finance. So literally everything is negotiable. The down payment is negotiable. The interest rate is negotiable. Honestly, even the purchase price is negotiable. And in reality, this property is selling for less than this amount. So you're providing them interest by buying it at a higher value. So the listing price for, like, if someone went traditional, is lower than this amount. But because this was the offer that was made, is, hey, we'll pay you more for it if you're willing to do seller finance, having a 10% down payment. And then now you can structure the interest rate. Honestly, to see what the best case scenario would be, you'd say this is 0% interest, right? This is a principal only loan. You're paying no interest. See if that works, because you're baking in around $30,000 in this scenario of interest in the purchase price. You're buying it for more than you would have bought it traditionally for the seller financing, but then that means you can adjust your seller financing terms as well. At the end of the day, it depends on, is the seller willing to move forward with this or not, and how can you renegotiate. But the best case scenario of 0%, it's going to take your monthly payment from, actually, let's go from $2,104, right, at 6% to $975, right? It's going to be a drastic difference. It's going to make this deal phenomenal. Obviously, your cash flow went up significantly and nothing else changed. And your actual principal pay down went up drastically. And just to show you what that looks like. So I went back. If you look at the principal pay down, you're paying down the debt $8,486 that first year at 6% interest. Well, if this is at 0% interest, not only are you getting way more cash flow, you pay down almost twice that amount in debt pay down. So you're not only adding to your equity, right? You're not only decreasing the debt more quickly, but you're also getting more cash flow. That's why my favorite is seller financing and renegotiating those deals, because the closer you can get to low interest, the better. The lower the interest, the better. I don't think they'll accept 0%. And if they did go 0%, you'd have phenomenal terms, right? This would be a phenomenal deal. It'd crush it. However, you need to also be realistic. So you need to understand kind of where's the highest you can go. You could say, hey, I can pay you close to $1,000 a month, principal only, get you this purchase price. We're baking in some of the interest. They might say, no, that's not going to work for me. It really depends on their goal. I don't know if the seller's looking to defer capital gains and they don't want to pay a bunch of taxes this year. I don't know if they need a bunch of money up front. I don't know if they care about the interest. I don't know what their main thing is, but we're going to see kind of where does this cross the line to at least make 15%. So we're going to go to 5% interest rate, 1884. And I think that'll already get you 15% cash on cash return. So basically, if you pre-raise some of the reserves and you get the seller to go to a 5%, so let's do the overall terms. If you get them to go $309,000 purchase price, 10% down payment, the rest is seller finance, right? The difference between the purchase price, the down payment is what seller financed. At a 5% rate, you're paying them $1,884 a month in the seller finance loan. You have your taxes, insurance, and you have your other expenses, your utilities, landscaping, internet for CoLiving, plus your passport management fee, plus your property management fee, your vacancy, maintenance, and CapEx, all that here. And you're raising right? Almost $20,000 in reserves for your property to get it set up and ready to go. Plus, if something comes up, that would net you around $1,500 a month in cash flow, 17.4% cash on cash return. That's an awesome deal for you and for your partners. If you went the 0% route, like you kind of know the highest you can offer them with these terms is 5%. So like your max, 5%. And that generates you, honestly, I'd say your max is probably 5.5%. We can try that and see. It's cool that it's a calculator. You can edit that. So 5.5%. Let's look and see what so that's still over 15%. You can honestly even go to 5.75%. That's basically right at the limit. So you can max do 5.75%. 5.75%. And then that is around 15.4% cash on cash return. And that's what the super investor is looking for, at least 15% cash on cash return, because they're going to raise the money for this deal. It's actually going to be 2 deals. It's pretty cool. So they're going to get 2 creative deals on this from this one seller. But that's the max you can go. I don't want you to negotiate like the bare minimum of what you're looking for. I would focus and understand what is the most important to the seller. It sounds like this purchase price is very important and they want at least $39,000. Well, if that's the case and the monthly payments are not that big of a deal, I would really focus on saying, hey, I will get you your purchase price and the down payment you're looking for. However, I can pay you around $1,000 a month each month on the loan. And I wouldn't even focus on I wouldn't even focus too much on the interest. I would basically, we saw it's basically 0%. It's really like 0.5%, or you can just hard code it. You can do 0% and say either to increase or decrease the payment, either you're adding interest or removing it, or you're increasing the term of the loan, or you're decreasing it. Doesn't mean there won't be a balloon where you won't have to pay off that loan amount in full, but having this at 30 years, maybe having it it would take 29 years to pay off. Let's see. That's pretty close to $1,000 a month. So having it at 0% interest, 29-year term, that's around $1,000 a month. This is the best case scenario. They may not accept this. Understand that. It's all negotiations. I don't know why a lot of people just they're like, oh, like they don't take the extra effort. This is like so important. Take that extra effort and say, hey, are you willing? Like, I'm giving you the purchase price that you want and the down payment that you want, and then understanding the massive benefits for you as the buyer, right? It's got to make sense for the seller to make sense for you as the buyer. Put in that extra effort and say, I'm giving you the purchase price you want. I'm even overpaying you for what I think it's worth right now. Giving you the down payment that you need. You need around $40,000 or $39,000, 10% down. And the rest, I will pay you $1,000 a month, every month till the loan is paid off, right? That's what you want to do. You want to pay it indefinitely and have that at 0% interest. Even if you're not explicitly saying that, you could say principal only payments. You could say $1,000 a month payments, whatever, however you want to phrase it. And understand that this deal then is now $2,368 cash flow, 28% cash on cash return. They may not go for that, right? Worst case scenario, you can still make this deal work at 5.75%, 30-year terms. Start somewhere low, anchor with them. Don't piss them off, right? That's why it's very important to phrase this is why it's so important to phrase the fact that I'm giving you the purchase price that you want. We're baking in a lot of your interest in this purchase price. I'm buying this at above market value because I'm baking in your interest for over the next several years for this deal. And for you, it's phenomenal because if you're able to get it, once again, at 0%, not only are you getting massive cash flow and cash on cash return, but you're also getting, if the property is appreciating, right? If it's appreciating in value and you're buying in great markets, this is a 4% appreciation, I believe. You're paying down almost $15,000 of debt because it's 0% seller financing. You're literally just every single monthly payment is paying down debt. Look at the amortization schedule. Your monthly payment at $975 in this scenario, no money is being wasted on interest. Interest is great for tax deductions, but what's better than that is paying down the literal debt. You may or may not be able to structure it this way, this perfectly. However, understand that your range, right? Your range is I can do no more than 5.75% interest rate. If I get to zero, freaking phenomenal. But somewhere in the middle, it's still solid. If you end up starting at, right, a little give and take without pissing them off, you end up at around 3%. Well, now you still have almost $2,000 of cash flow, $1,896, $1,900 of cash flow, 22.4% cash on cash return. And you're paying down around $11,500 of debt, right? That's awesome. That is freaking incredible. Maybe it's 4%, maybe it's 5%. I don't know. This is going to be up to the super investor, the seller, and the wholesaler he's working with to try to structure something like this. But now he knows his boundaries. If he's buying it at 390, 10% down payment, if he does anything over 5.75%, it does not hit his returns. It doesn't make sense. I wouldn't start there. I would start much lower and try to understand what is very important for the seller, what is important for their payments. If it's $1,000 a month, they get the payment, like they get the sale price they want, they get the down payment they want, and they're cool with $1,000 a month. Great. That's basically principal only loan, which is the best case scenario. Otherwise, if it's some percentage and it's the 3%, let's say, and it's $1,500 a month, I wouldn't even focus on the interest rate. People end up negotiating against themselves by saying, hey, would you accept 3% interest? Well, the seller usually doesn't even know what the hell that means. They understand that 3%. Well, I want more than 3%. The most important thing is to talk about payments. Seller, so I'm going to, like, this is exactly how I'd present it. Hey, seller, so I'm going to buy this above market value. We both know it's not selling currently for $369. I don't see a ton of interest at this price. However, because I'm buying this as a rental over the longer term, as opposed to just buying it for the trying to get a discount, like, getting a $10,000 discount, whatever, where that's where majority of other people renegotiate. If you're open to seller financing at 10% down payment, right? I can pay you around $1,500 a month each month. Would that work for you? Right? You're not even talking about the interest rate. Or you could say $1,000 a month. You could say $1,200, whatever, and then back into what the interest rate or the terms it would take to get there. Because you could even do that at 0% if it was $1,500, and do this at this would mean you'd have to pay it faster. So around 20-year term versus a 30-year term, right? You can always back into this $1,500 by adjusting the term as opposed to adjusting the interest. But they may not be open to only principal only. This is why it's so important, at least for super investors. I'm talking to you guys, super investors, as well as other real estate investors, but especially super investors, why it's so important to understand how all this works and what can be adjusted to get you the payment, and how to phrase this correctly. Even when it's a deal from a wholesaler, if the deal's not selling through the wholesaler, well, the seller probably wants to get the deal done. It's not selling on market. It's not selling to the wholesaler. How can you make that a better deal now for everyone involved? And at least get it done. It's got to work for the seller. It's got to work for you as the buyer. That would be my advice on this one. You obviously can't do over 5.75%. Otherwise, it doesn't hit your overall goals. Best case scenario, you figure out what the monthly payment is they're looking for. Disregard the interest rate in particular. Try to go principal only because the massive debt pay down. And they want a balloon. Okay, so someone said, Sub2 Sean said, he's doing my man Matt said, this is fire. Thank you, brother. I mean, I'm just trying to help you guys in your investing journeys. That is literally the goal here. But Sub2 Sean, I got a few more minutes. He said, in the middle of not co-living, but seller finance, and they all want a balloon. Well, it depends on what balloon they want. So that's the cool thing about the calculator. If you just scroll to the right, seller finance, let's say it's a balloon in 10 years. Well, in 10 years, you would have paid down $184,000 of principal. And if you have let's do this like normal scenario. Let's go 3% at 30 years. In that instance, in 10 years, you would have paid down $84,000 of principal. The seller would have got $93,000 of interest in 10 years, right? Hopefully you can see this. Could zoom in a little bit more. And so the balloon payment in 10 years would be $266,000. Well, not only will the property appreciate in value over the next 10 years, you're also paying down the debt $84,000. So is that worth it for you? Well, you've gained a bunch of equity. Let's see if you This is the super investor calculator, right? So, you have to have this, but in the end of 10 years, you would have made $286,000 of cash flow. You would have paid down $132,000 of debt. Is that what I said? Oh, it's got the sub 2 loan amount. Let's get that to 0 and that'll solve this. Where's 5 years? Oh, 10 years. Weird. I don't know what's going on here. I'll have to fix this, but let's see. Nonetheless, you would have paid down $84,000 of the seller finance principal. You would have paid down the, I think this is there. So we got rid of the sub 2 loan amount. You would have got, all right, so pay down $84,000 of the principal. You've literally paid down that debt, or actually your tenants did. It's even better. The tenants pay down that debt. The property will appreciate in value. It'll appreciate, a couple $100,000 over that period of time. You pay down $84,000. There you go. Of debt, and you've gotten $286,000 of cash flow. So, okay, yes, there's a balloon in 10 years, or there's a balloon in 5 years is kind of cutting it close. I'm not a huge fan of 5 years. I like 7 or more, but let's see it in 5 years. You pay down $38,000, almost $39,000 of principal. Property is appreciated. So let's go to the 5-year marker. Property is appreciated around $100,000 in this scenario, just 4%. That the national average is 5%. If you're in a better market, right, the better the market, the more people want to live there, the more your properties will appreciate, as long as the economic indicators are good. It's Atlanta, pretty good standard market. It's not like my San Diego ones that appreciate much more. It's not like, besides COVID, it's not like these little Mississippi markets or whatever that probably don't appreciate much except for during COVID. But in those 5 years, you've gotten $126,000 of cash flow. Your tenants have paid down almost $39,000 of debt for you. Your property's appreciated in value. So even if there was a balloon, would that be something worthwhile? Of course, that'd definitely be something worthwhile. Whether you're the one investing in it yourself or your partners, it's ultimately up to you. I would really try to stray from balloons, or if you have a balloon, my favorite contingency is, okay, we can do a balloon. However, the loan will continue, the seller finance loan will continue to extend indefinitely 1 year at a time until I get a 75% loan to value. So that means the property value at that time with an appraisal, right, divided by the existing loan on the property, the loan to value, loan divided by the property value needs to be at least 75%, because then that means you can refinance the property with new debt, or you can sell it and have that 25% equity and make some profit on that in addition to the cash flow that you made. If it does not hit that contingency, it just extends for a year and a year and a year, right? That's like the number one thing I do when anyone wants a balloon. There's always a contingency based on seller financing. Yep, exactly, my friend. Drop the bomb on that one. That is a secret sauce for balloons and extending those. That's a great way to do it based on the equity of the property. So hopefully that answered it. I know we didn't go too far into the weeds, but various ways to handle balloons, understanding, yes, you may not own every property for 30 years at these terms. It's okay. Properties will appreciate in value. You're going to make a bunch of cash flow if you're structuring these right up front, make a bunch of cash flow in the meanwhile. And you're also going to benefit massively between cash flow, appreciation, and debt pay down, especially if you structure it well. And ideally, if you're doing this thing right, like myself, you're not paying taxes for, I don't know, the last several years, I haven't had to pay any taxes, all thanks to real estate. So, all right, y'all, that is that. I shared a ton. If you want the free calculator, I'm dropping it again. I'm dropping the link in here. Free calculator, it's in there. Yeah, so if you want the super awesome Super Creative Finance Calculator, that is in Super Investors, like the one that I just presented all this stuff on, Super Investors. And it's not just the freaking calculator. The calculator is one of many tools that I provide when it comes to capital raising, deal analysis. I just did a whole freaking training on fractional, how I raised over $800,000 in 48 hours for a big co-living raise, how we're doing it right now again for 30 co-living room rentals in Texas. That one will be presented tomorrow. So if you want to come out to that, whether you're looking to actually be a private money partner on that deal for as little as $5,000, or you're just looking to learn, come hang out. I'm happy to share all that with you.